As always, please read this slide. Please take your time, read it, pause the video before continuing. It's very important that you take a look at this. I've already explained what each one of these mean in the first video that I released of this series. Okay? Welcome to the No BS ICT Explained series, and in this video I will be talking about premium discount arrays. So without further ado, let's get started. Okay, so let's talk about premium, equilibrium, and discount zones. For premium, that means that you are going to be looking for sells only in this zone. For the equilibrium, it's essentially the 50%, or it's seen as a general discount area no matter the type of trend. We've already talked about what the equilibrium means, but you can also find the equilibrium with your Fibonacci. And lastly, this discount zone means that you will be looking for buys only, okay? And in this example, you can see the premium, the equilibrium, and the discount zone, right? You are going to be trading with the trend when it comes to using premium, equilibrium, and discount zones. Here you can see we have a downtrend because of the high and low consecutively making more lower highs and lower lows. As you can see, if you were to draw your fib from the top to the bottom, you can easily see the 50% zone or the equilibrium, and you would be looking for sells anywhere on top of this zone or area. Same thing here, you draw it from here to here, price retraces up to here over the premium, or it even touches the 50% zone, and you could have looked to sell in this area. If you go over here, you can see I have marked this as a non-trading opportunity, because even though we drawed it up from the bottom to the top, this never reached the 50% area or the discount zone, which means you should have skipped a trade for that day. Now, I'm not saying you can't trade those days, but I would recommend you to be strict on your trading plan. Even though, yeah, sometimes the trades can play out, but it's not always like that. Some people get desperate and say, oh, this type of trading style obviously doesn't work because I missed a trading opportunity. When in reality, it doesn't always happen, and then you start changing your plan to where you start taking these trades as well, even though it doesn't tap into the equilibrium or discount zone, and then all of a sudden you start losing trades because you switched up your entire plan instead of just sticking to it and being strict. And as you can see, if you were to draw it up again and you were patient, you would have gotten a retracement to the equilibrium or your discount zone. This is the 12-hour time frame you can actually use this on, and this applies to any time frame. I'm just using the 12-hour as an example. Okay, now let's talk about the simplified definitions of some ICT concepts. First one, old highs and lows. These refer to previous swing highs and lows in the market. They are crucial in understanding where liquidity stands. Order blocks. An order block is like a hot spot on a price chart where big players have shown interest in the past. These hotspots can act like barriers or stepping stones for price, making it either bounce back or break through. Fair value gaps. These are three candlestick patterns that indicate an imbalance or inefficiency between buys and sell sides. Volume imbalance. These occur when there is a sudden movement away from a right price range due to a lack of buy or sell side liquidity, but the market will eventually balance itself out. Breaker blocks. These are supply zones turned into demand zones, or demand zones turned into supply zones. Mitigation blocks. These are the same as breaker blocks, but with a few extra steps. For example, you are in an uptrend and then all of a sudden have a failed high, then price breaks a low, and turning that low into an order block where price comes back and reacts from to continue back down. Lastly, liquidity voids. In the context of ICT, liquidity voids refer to situations where there's an imbalance in price delivery. This usually happens when there's a sudden movement away from a price range due to a lack of buy side or sell side liquidity. Now, I have obviously oversimplified these terms, but I only did it so that way you guys can understand them a little bit better. And I have attached links or hyperlinks to each one so that way you can look at an example of what each one would look like. Now, I'm not going to go over every single example, but I do want to show you the mitigation block and explain it to you a little bit better. And as you can see, we were in an uptrend, right? So we were going down, up, down, up, down again, and then we had a failed high. It failed to break this previous high right here, and then it comes down, breaks this low, okay, goes down, takes out some liquidity, retraces up to that broken low, making it a failed demand zone, and then price bounces off and then continues back down. Now let's take a deeper look. I want you to pay very close attention to what I'm about to show you. If you can, rewatch this video, or at least this section of the video. It's very, very important. Alright, breaking down the PD array. The PD array includes different elements that traders look at, such as old highs and or lows, order blocks, fair value gaps, volume imbalances, liquidity voids, mitigation blocks, and breaker blocks. These elements help traders understand where to buy at a discount and sell at a premium in the market. Now let's consider a scenario in the trading market when in a premium area. First one, observation. First, you notice a substantial push down in the market that leads to a fair value gap. This is like seeing a sudden drop in the price of your favorite video game. Next, consolidation. Then the price starts consolidating below this gap, forming recognizable equal highs and lows. Now, it doesn't always have to form an equal high and low, but again, this is just an example that I'm talking about. This is similar to noticing that the price of the game isn't going any higher or lower and is staying around the same level. Third, the trade setup. The real trade opportunity comes when the price breaks through the equal highs, enters the fair value gap, and taps into an order block positioned above the gap. This is like seeing the game's price start to rise again, reaching the original fair value gap and then a higher order block. The confirmation. This confluence of factors instills a heightened confidence in the reliability of the trade idea. It's like being sure that the game has reached a high enough price to finally sell it. And here I have an example. As you can see, price pushed down aggressively, causing a fair value gap, makes some equal highs here, here, and here, and then some equal lows here, here, and then price finally breaks through, touches the fair value gap, still moves up a little bit more, taps into the order block, and then finally sells down. Pretty easy and pretty simple, right? Now, I want to talk about order blocks according to ICT just a little bit more, because I think it's very, very important and it's really crucial to a lot of his teachings. Let's simplify this for someone brand new to Forex trading. Picture an order block like a turning point on a roller coaster ride. It's where things change direction, whether it's going up, bullish, or down, bearish. Now think of validation as the roller coaster going over a hump. For a bullish order block, it's like the roller coaster going up and over the highest point of the block. If it does that, it's a good sign that the ride will keep going up. And for a bearish order block, it's like going down and under the lowest point of the block. If that happens, it suggests that the ride might continue downward. When the price moves away from this turning point, and then comes back to it, pay attention. If it bounces off, it's like the roller coaster hitting a springy spot and then shooting off in the opposite direction. That's a clue that the trend might continue. Now, to keep things safe, if you're on this roller coaster and things go south, you'll want to know where to stop the ride. For a bullish order block, that's at the lowest point, and for a bearish one, it's at the highest point. And just below halfway up or down the block, it's like putting a safety net in case things get a bit shaky. Imagine you're watching this roller coaster ride on a daily support level. The ride might go down, tap the support twice, bouncing back up, creating a turning point or order block. Then it shoots up, comes back to test the area, and bounces again. That's the basic idea. Finding these turning points for potential trades, keeping an eye on the ride, might continue. Here is an example that I'm going to show you real quick. So we have our daily support level. Okay, as you can see, it's touching, right? Touches the daily support twice, goes up, and then finally we touch one more time. Price goes back up a little bit, retests it, making this our demand zone, and then price shoots back up, taking out some liquidity. And you can move your stop loss after price has moved with some momentum. Now generally you can put your stop loss under this order block. It's generally safe, right? Generally. Now you might get stopped out here and there, but that's okay. That doesn't mean you're doing anything wrong. That's just price doing its thing. Read this carefully. See if you can find a chart or an area where something similar like this can happen and practice it, or just look at it. Just go back in time, see if you can find something similar. Alrighty, now let's talk about rejection blocks. Think of rejection blocks as areas on a chart where the price gets a strong nope and turns around. These usually happen at important levels where price either bounces back up or drops back down. Imagine you see a new spot on the chart where the price said, I don't want to go lower than this. That little pointy part at the bottom or top, depending on the candle, of a candlestick, that's the wick. If the price bounces off that wick after going down, we call it a rejection block. Now when the price goes back to that rejected spot, it often bounces off again. Picture it like a ball hitting the ground and bouncing back up the area between the wick and the top or bottom, depending on the type of candle, obviously if it's bullish or bearish, of the next candle is where the action happens. To keep it simple, instead of just seeing it as a wick, imagine it as a pretend box with no pointy ends. Rejections of these zones are quick and strong, like slamming on the brakes or hitting the gas pedal. So, in a nutshell, rejection blocks are like spots on the chart where the price gets a firm no and changes direction. These zones can lead to rapid and forceful moves in the opposite direction. Now let me show you a quick example of what I mean. As you can see, this is the area from the opening of price and the wick. And as you can see, price taps it and then quickly rejects off of it. And it even came back and tapped into it again, but had a strong rejection. Imagine like you're putting your finger in boiling water and you quickly pull it out. That's kind of how price reacts to these zones or areas. Now, price isn't always going to look like this, or you won't always have these kinds of reactions, but they can happen. Okay, so just keep an eye out for that. Alright, so I want to talk about two types of liquidity runs. The first one is high resistance liquidity run, or HRLR. This is like a bumpy road with lots of stop signs. Orders are stacked up at key levels, waiting to be triggered. High resistance liquidity runs can be more volatile and risky than low resistance liquidity runs because the price can face sudden stops and reversals as it runs into these order clusters. However, they can also be profitable if you know how to identify them and manage your risk carefully. Now here is an example. As you can see, price shoots down, takes out some liquidity, comes back up, stops, goes back down, takes another bit of liquidity, comes back up a little bit, then shoots back down, taking out this liquidity, and then comes back up a little bit more. Now, if price wants to reverse at some point, it's going to have a hard time because of all this liquidity up here. Now let's move on to the low resistance liquidity runs. Now for low resistance liquidity runs, think of this like a smooth highway with no traffic lights. It's the easiest path for the price to take because there are few orders waiting to stop it. Low resistance liquidity is witnessed when the price exhibits swift, undirectional movements without zigzagging. In this scenario, there are minimal levels where the price encounters halts. When the price descends or ascends to access this form of liquidity, it faces little resistance. The movement is smooth, capitalizing on areas where buyers or sellers previously existed, enabling a swift continuation in the same direction. Now I got another example. Here you can see it touched some liquidity as it was going down, but not big retracements, very small, goes down, takes out some more liquidity, small little retracement, goes down, and then shoots up with very little resistance, taking out this liquidity as it's changing direction or just does a pretty big pullback. It depends on what the trend or what price wants to do for that day. Now let's talk about the ATM method. The ATM method is like looking at the bigger picture. It's about finding opportunities for substantial trades that play out over a longer period. Here's the deal. First, you identify a breaker block on a higher time frame chart. Think of it as a significant turning point on a long-term roller coaster ride. Once you spot this breaker block, you shift your focus to a shorter time frame. This is like zooming into to see the details of what's happening in that turning point. Now the plan is to wait for what's called a retest. It's like double checking that the price or that the turning point is legit. If the price hits that point again and bounces, that's your cue. For safety, you set a stop loss just below or above the extreme low or high. It's like having a safety net in case things don't go as planned. And your big goal, well, it's like aiming for the next massive area where lots of buying or selling is happening. We call it a large pocket of liquidity. In a nutshell, the ATM method is about using a significant turning point on a larger term chart to spot potential big trades. You then dive into a shorter time frame, wait for a confirmation, set up safety measures, and aim for the next big zone where the market is making moves. There's a bit more to it, but that's the basic idea in a nutshell. So let me open up this example. As you can see here, we are on the 12-hour chart. There is a breaker block here. We zoom into a 5-minute chart. This is just an example. It doesn't have to be a 5-minute chart, but it's really good for capitalizing on bigger trades so you can get really good entries. Or you can always put a limit order. It's up to you, but I wouldn't suggest limit orders. It can be seen as gambling. Well, I'm not gonna lie, every now and then I do put a limit order on there. But anyways, you drop down to the 5-minute. You look for anything that may be a confirmation for you. So here, as you can see, you could have entered here, limit order style, and price is going up, down, goes all the way up, targeting this higher time frame liquidity. And if you would have entered at a really good lot size, you would have made some really good money, especially if you would have capitalized on all of this. All right, so this doesn't always happen, guys. It doesn't always form, but when it does, you can definitely make some really big money. All right, so thank you so much for staying all the way to the end. watching the video. I hope you learned something. I hope that it fills your brain with so much goodness. I mean, just the amazing amount of information that you have just received has to have been rewarding, and hopefully you will use it for something good. And if you are struggling to understand ICT, I really hope that you continue to watch this series and continue learning his incredible teachings. Now, before I go, I just want to leave you guys with a little bit of wisdom here. And this is from Proverbs 24, 3-4. By wisdom, a house is built, and through understanding, it is established. Through knowledge, its rooms are filled with every precious and beautiful treasure. So everyone, I hope that y'all become blessed traders. And remember, trading is subjective, but God is not. I'll see you all in the next one. Peace.